Welcome back to Smart Stock Sam, the channel where we cut through the noise, skip the hype, and get to the actual numbers that matter. If you are new here, hit that subscribe button right now because you do not want to miss what is coming. Today, we are going deep into the HIMS pivot story. What caused the crash? What the insiders are doing? Why Wall Street analysts are miles apart from where this stock is trading, and the tactical trade setup inside the final week of May that could ignite a violent short squeeze. I am going to lay out the exact levels you need to watch, the exact triggers that confirm the bull thesis, and the exact point where the bear case officially takes over. The title of today's video says it all. Do not buy the dip until you see everything I am about to show you. This situation is more nuanced, more layered, and more dangerous than a surface-level scan will ever reveal. Why is this company down nearly 27% year-to-date? Why is it sitting 66% below its 52-week highs? And is this a falling knife or a generational buying opportunity hiding in plain sight? To understand where HIMS is right now, you have to understand what they are walking away from, and more importantly, why. For a while, HIMS was riding an incredible wave. Compounded GLP-1 weight loss products, the kind you cannot get at your local pharmacy, were a massive revenue driver. These were high-margin, fast-moving, and they gave HIMS a unique edge in a market absolutely desperate for affordable weight loss solutions. But here is the thing about building your growth engine on top of a regulatory gray area. The ground can shift underneath you at any moment. And for HIMS, it did. And when management looked at the road ahead, they made a decision that almost no one saw coming with this speed and this ferocity. They decided to pivot hard toward branded medications. We are talking Wegovy. We are talking Ozempic. The big names, the FDA-blessed products, the ones that carry not just market legitimacy, but long-term structural safety for a publicly traded company. And pivoting in that direction meant one thing. They had to write down $33 million in compounded semaglutide inventory. Gone. Just like that. A $33 million restructuring charge in a single quarter. Could you imagine waking up and signing a check that big just to change directions? That is exactly what happened here. Now, why would a management team do something that painful, that immediately destructive to the balance sheet? Because the math on the other side of this pivot is enormous. Branded medications expand the total addressable market in ways that compounded products simply cannot. They lower regulatory risk dramatically, and they open doors to a global customer base that the compounded model was never going to unlock. The market hates uncertainty. And right now, the market is punishing HIMS for the near-term margin compression required to secure what management believes is a structurally superior future. The question is, are they right? And more importantly, are they going to execute? Now let us talk about the price action, because this chart tells one of the most dramatic stories of the year. We are looking at a tale in two brutal acts. Act 1 happened on May 11th. Earnings dropped and shares plummeted 15% in a single session. Why? Because investors were completely blindsided by a surprise net loss in Q1. A $92.1 million net loss. Negative 40 cents per share. For a company that was supposed to be growing into profitability, that number landed like a grenade. Act 2 happened on May 18th. Just as the stock started showing some signs of stabilization, management announced a $402.5 million debt offering. And in one day, another 10% got wiped off the board. We went from a 52-week high of $70.43, a number that feels almost fictional right now, all the way down to a current price hovering around $23.75. That is a 66% haircut from peak to current, 66%. On a company that just raised its full-year revenue guidance. Does that make any sense to you? Because it should not. And the disconnect between those two facts is exactly where the opportunity and the danger lives. Let us break down the Q1 numbers so you really feel what happened. Revenue came in slightly below expectations. Net loss hit $92.1 million. And EBITDA guidance for the near term was lowered. Meanwhile, management simultaneously raised full-year 2026 revenue guidance to between $2.8 billion and $3.0 billion. This is what I call the HIMS dichotomy: lose now, dominate later. They are investing, and I mean investing aggressively, in international expansion, branded infrastructure, and an AI-powered platform they believe will create a moat so deep that no competitor will be able to touch them by 2027. The bull thesis is straightforward. The execution risk is enormous, and one bad quarter away from that $92 million loss becoming the new normal is the nightmare that keeps bears short and loud. Now, about that $402.5 million capital raise, let me give you something you probably did not see in any headline. They secured this debt at 0% interest. Zero. In the current macro environment, raising $400 million at absolutely no interest cost is, frankly, almost unheard of. It is basically free growth capital. They are using every dollar to fund international expansion and their AI platform build-out. But here is the catch, and this is critical for anyone thinking about buying shares right now. These are convertible notes, meaning the debt converts into shares at a set price. That conversion price is $29.53. What does that create? A mathematical ceiling, a psychological wall, because as the stock climbs toward $29, the fear of dilution kicks in. Investors start doing the math. They realize that new shares could flood the market at exactly that price level, and that fear acts as a cap, a lid on near-term share price appreciation that is both a psychological and a technical barrier. Brilliant for the company's long-term balance sheet, frustrating for anyone hoping for a clean, unobstructed breakout. So what are they building with all of this capital? Because the story is bigger than pills. HIMS is constructing what they call a global tech health ecosystem. There are two massive pillars here. Pillar one is global footprint. They have a $1.15 billion acquisition of eucalyptus in the works. That is their gateway into Australia and Japan. And just days ago, on May 21st, they launched generic semaglutide in Canada for approximately $149 per month. They are not building a domestic drug company. They are building a borderless health platform. Pillar 2 is artificial intelligence. They are deploying what they call a multi-agent AI model across their entire ecosystem, from biomarker interpretation through their lab's AI product to a weight loss companion app that turns a one-time customer into a lifelong AI-driven health subscriber. Think about what that means for recurring revenue. Think about what that means for customer lifetime value. The question is not whether this vision is compelling. The question is whether this management team can actually pull it off. And that question is exactly what divides this market into two very loud, very passionate camps. The bulls look at this stock and see a massively mispriced growth story. Long-term cash flow models built by institutional analysts suggest a fair value north of $80 per share. They think the market is overreacting to what is essentially pivot noise, temporary margin pain in exchange for a platform with extraordinary terminal value. The bears, on the other hand, see fragile profitability and a company that needs a literal hockey stick ramp in EBITDA to hit their own year-end targets. One missed execution milestone, and that $92 million loss does not look like a one-time event anymore. It looks like a trend. Right now, the market is pricing in the risk, not the potential. So who is winning this debate on Wall Street? Let us look at what the big banks actually have to say. The analyst consensus on HIMS right now is fascinating, and honestly, a little alarming when you stack it against the current stock price. Truist has a hold rating with a target of $23, the most conservative call on the street. But then look at where everyone else is sitting. Bank of America has a target of $30. JP Morgan is at $33, and Needham is leading the charge with a buy rating and a $35 price target. The consensus mean sits somewhere between $26 and $27.84. Here is the single most important takeaway from these numbers. every major institutional target, with the exception of Truist, is meaningfully above where this stock is trading right now. That gap, the gap between current price and analyst targets, does not usually stay open forever. Something has to give. Either the analysts are wrong and need to cut their targets, or the stock is wrong and needs to move higher. Which direction do you think is more likely? But before you get too excited about analyst targets, let us talk about the institutional and insider flow data, because this is the danger zone that most retail investors completely ignore. During this pivot phase, we have seen a 17.36% decrease in long institutional shares. Big players, including names like BlackRock and Vanguard, appear to be de-risking as restructuring uncertainty peaks, and insiders have been cautious as well. CEO Andrew Dudum executed share sales earlier this year, and just this week we saw transaction filings from 2 board members as well. When the big money is moving to the sidelines, it creates a supply and demand imbalance that keeps the price suppressed regardless of how compelling the AI story sounds in an earnings call. This is the institutional headwind every buyer at this level is fighting against. It does not mean the stock cannot go up. It means you need a catalyst strong enough to overcome that selling pressure. Now let us talk technicals, because the chart is sending a very specific message right now. HIMS is in what I would call a structural bear trend. It is trading well below its 200-day moving average of $35. The 20-day and 50-day moving averages are both sloping downward. The MACD is sitting below the signal line, a classic do not buy the trend signal for momentum traders. However, and this is important, look at the RSI. It is sitting at 60.09. That means the stock is climbing out of deeply oversold territory and recovering toward a neutral to bullish zone. The short-term momentum is starting to stabilize. The stock is trying to find a floor. Whether that floor holds is the entire game right now. And that brings us to the single most exciting part of this entire story for short-term traders, the short interest setup. HIMS has approximately 29.94% of its float sold short. That is over 63 million shares betting against this company. Days to cover sits at 3.43, meaning it would take more than 3 full days of average trading volume for all those shorts to exit. Now, look at the options chain for May 29th. There is a massive wall of open interest sitting at the $25 strike. If this stock can break and hold above $25, something very specific and very violent happens. Call sellers are forced to hedge by buying shares, and those 63 million shorted shares face a wave of stop-outs that could trigger a cascade of panic covering. That $25 level is not just a number. It is a psychological barrier, a technical trigger point, and potentially the ignition switch for one of the most explosive short squeezes we could see this month. Could we see a 30% move to the upside in a single week if that level breaks? The math says it is possible, even if it seems improbable right now. So here is the actionable game plan for the post-Memorial Day shortened trading week, May 26th through May 29th. The tactical entry zone I am watching is between $23 and $23.75. For a bullish confirmation signal, I need to see a clear break and hold above the $24.25 Fibonacci pivot level. Primary resistance above that is the $25 options wall we just discussed. On the downside, primary support sits between $21.50 and $22 even. That is where buyers stepped in aggressively after the debt offering hit. My strict stop loss is set at $21.25. If HIMS breaks below that level, the bear thesis takes structural control and we step aside completely. Short-term target for a gap fill is $26 even. Medium-term target is $29.50, which, not coincidentally, is almost exactly where that convertible note conversion price sits. Everything is connected here, and the smart money knows it. Looking beyond this week, there are 2 monitors you need to have on your dashboard for the next 6 months. First, weekly Wegovy subscription numbers. HIMS management is targeting over 100,000 new monthly subscriptions as a signal that the branded pivot is working. If those numbers start hitting, the market narrative flips. Second, the Q2 revenue print. They need to show a credible path to $700 million in quarterly revenue. Miss that number and the bear thesis gets very loud, very fast. Longer term, everything rides on the eucalyptus integration mid-year and whether this company can build a credible bridge to net profitability by 2027. This is no longer a meme stock momentum play. This is a complex, high-stakes execution story that demands your full attention. Now, before we wrap today's video, I want to be very clear about something important. Nothing in this video is financial advice. I am not your financial advisor. I am not your broker. Everything I have discussed today is purely for educational and informational purposes only. Stocks carry risk. You can lose money. Past performance and analyst targets do not guarantee future results. Always do your own due diligence. Consult a licensed financial professional before making any investment decisions, and never invest money you cannot afford to lose. HIMS is a high-volatility, high-risk, high-reward situation, and I want you going into it with eyes wide open, not chasing hype. So here's the final verdict on Hims and Hers Health. The strategic pivot to branded medications was painful. It damaged margins, it crushed the stock, but it definitively expanded this company's addressable future and lowered its long-term regulatory risk profile. The crash we witnessed was not random. It was a mathematically logical reset of market expectations colliding head-on with a company choosing long-term dominance over short-term optics. Between the 0% financing deal, the growing global ambitions, and that jaw-dropping 30% short interest, we have a high-volatility setup that could reward the patient, disciplined investor, or punish the impatient, emotional one. For the rest of May, success or failure hinges on one thing: HIMS defending the $22 support floor and making a legitimate run at that $25 options wall. If it does that, the HIMS pivot just might become the turnaround story of the year. Now, I want to hear from you. And this is a genuinely important question I want you to think about before you answer. Given everything we just laid out, the brutal margin compression, the free capital raise, the institutional de-risking, and the 63 million share short float, do you think HIMS has already bottomed, or do you think the real pain is still ahead? Drop your answer in the comments below, because I read every single one of them, and your perspective genuinely shapes the content we make here. If this breakdown gave you value today, do me a favor. Smash that like button. It helps this channel reach investors who actually need this information. And if you are not subscribed yet, what are you waiting for? Hit subscribe and ring that bell so you never miss a Smart Stock Sam breakdown. And if you really want to support the work we are doing here, you can send a super thanks directly through YouTube. Every contribution helps us go deeper, research harder, and bring you better content every single week. Until next time, stay sharp, stay patient, and I will see you in the next one.